At the moment, we're in a very unusual situation. We're being paid very well to take as little risk as possible with money market funds. And that's because central banks have been raising interest rates in order to combat inflation. However, this situation will change. So in this video, we look at whether now is a good time to sell our money market funds and buy bonds instead. And if not, what are the reasons why we might want to switch? This video is sponsored by Trading212, a UK commission-free investment platform. Now, just to set the stage, you can think of your investments roughly as two buckets. There's a safe bucket and a risky bucket. And you can just build a two-fund portfolio where you just have one fund representing each of those categories. So what might go into our risky and safe bucket? So what would go into our risky bucket? Well, it would be things like stocks, obviously, but also real estate investment trusts, things like commodities, but also maybe high-yield corporate bonds. But the risky bucket is not the topic of this video. Instead, we're going to focus on the safe bucket. And that would contain things like cash and money market funds. Those two are very similar, but not identical. Then as we start to dial up the risk, we'd think about things like single government bonds, or maybe even portfolios or funds containing government bonds. So according to the income you receive for each of those safe investments, you might choose to swap out what you're invested in at any given point in time. And of course, the time when you have to think about this is during a time of transition, as we're about to enter right now. Now, a question I get asked a lot is which money market fund should I invest in? What are the rates of return on money market funds? If you look at accumulation money market funds, which I think are the simplest ones to understand, these invest in very safe things like any money market fund. So that would include short-term government bonds, commercial paper. These are short-term IOUs issued by companies, but also things like deposits at banks. And these carry very little interest rate risk. If interest rates move up and down, the price of the funds don't move much. So if you look at the value of these money market funds, you can see that they have a very smooth trajectory. But if we're looking at the rate of return on these money market funds, one thing you can do is just take the price 1 month apart and annualize that return. And that's what I've done here over time, going back to just before 2020. And these are 6 money market funds available in the UK. And the surprising thing is they're all giving pretty much a similar yield. It varies between about 5.2%, 5.8%, something in that range. Now, superimposed on these graphs is the SONIA rate. That's a sterling overnight index average rate. Cute name for something which is quite technical, but it's just the rate at which banks lend to one another. And it's also related to the central bank's policy rate, bank rate from the Bank of England. If bank rate falls, SONIA falls, and the rate of return on these money market funds will fall too. What you can also see on all of these graphs is that if we go back to 2022, when interest rates were roughly zero, these are policy rates set by central banks, including the Bank of England, these money market funds were earning almost nothing. So you could probably tell there were a spate of YouTube videos about money market funds that were made as that rate started to rise, including one of mine. I've also made a video for Trading212 on their channel, all to do with money market funds. So given that we're earning a pretty good rate of return on money market funds right now, why would we ever consider moving? Well, when you're thinking about that safe bucket, you'll always be thinking about rates of return. You'll probably choose whatever's going to give you the best rate of return possible. And of course, that varies over time. The other thing to understand about bonds is that the rate of return you receive depends on the duration of the investment. So how long are you locking in a fixed rate? What you can see here are individual UK government bonds. Those are the blue squares that you can see. And the x-axis tells you how long you're locking in a fixed rate. So these bonds have maturity dates of between 0 and 50 years for the UK. Now notice that the yields vary between about 4% at the moment and 4.8%. I've also superimposed the SONIA rate in March of 2024, which is well above any of those single gilts. The SONIA rate currently is around 5.2%, a tiny bit below that. So at the moment, if you've got a choice between taking some interest rate risk with one of these bonds because they have a fixed rate of return, and if interest rates increase, their price will fall, that's duration risk. Or alternatively, you can take almost no duration risk with a money market fund and earn more at the same time. So it's a bit of a no-brainer. There are other considerations. For example, capital gains tax isn't paid on UK gilts, so that makes them more attractive, and that pushes up their effective yield if you're holding them outside an ISA or a SIPP. But if it's within an ISA or a SIPP, clearly you'd probably choose the less risky and high yielding money market funds right now. If we look at the history of UK gilt yields, this is data from the Bank of England, and it goes back 50 years. You can see that what happened was that essentially yields rose as inflation spiked in the 70s and 80s, and it's been gradually falling since then. However, since 2022, as we got this period of high inflation again, what we saw is that yields increased across the entire yield curve. But what's notable at the moment is that the yield curve is inverted. Short-term interest rates are higher than long-term interest rates, and that's quite unusual. If we are going to go back to normal when inflation falls again, what would we expect to see? And what would normal be? Well, I'd say that normal would be where we were before the financial crisis, of course before the pandemic, and I've fairly arbitrarily chosen a date in 2003, in August. But the key thing on that date was that the curve was upward sloping. In other words, you were compensated for taking more duration risk, which is just rational. That's the kind of market which most fixed income investors would consider to be more normal. So if I take away the labels of all those bonds in the UK gilt yield curve, just to make it a bit cleaner, and I add the shape of the curve from 2003, notice the difference in the shape of the curve. In 2003, the Bank of England was not fighting inflation, and so its policy rate wasn't particularly high. The short end of the curve was quite low, and that's primarily driven by the central bank's rate. The long end of the curve is driven more by expectations about GDP growth and inflation, and that was considerably higher than it is now. So what would happen to yields if we went from today's curve, which is inverted, to the normal curve, which has some term premium? Well, you can see the changes with these arrows. The short end of the curve, which is currently over 4%, would move down to something like 2 to 3%, and the long end of the curve would move up. So with the belly of the curve, that's the point around 7 to 10 years in maturity. Now remember that prices and yields go in opposite directions, so for the long end of the curve, I think there could be some falls ahead, although I think a lot of the growth which we're getting at the moment, which is pretty tepid, is already being priced in. So most of the movement is going to be in the belly of the curve and at the short end of the curve. The belly of the curve will move up and the short end will move down with policy rates. Today's video is sponsored by Trading 212, a commission-free investment platform in the UK, and it's very innovative as well as being low fee. For example, if you open a new account with them at the moment, they're going to give you some cash back. And this is for people who open a new ISA between the dates January the 29th, 2024 and April the 30th, 2024. If you do that, you'll receive 1% cash back on your allocation to your ISA. Of course, that's a maximum of £20,000, so the cap is £200 for your cash back. Terms and conditions apply, of course. You have to have a Trading 212 Invest account, you have to be a UK resident, and you have to be at least 18 years old. Now you're probably thinking, does this £200 count towards my ISA allowance? No, it goes into your Invest account, which isn't your ISA account. And you have to keep the money in that account for 12 months after the deposit's made. Once it exits that lockup period, you can do anything you want with the money. Now, Trading 212 has lots of other great features like its pies. You can automatically rebalance those pies with the click of just one button. Very useful if you're running multiple investment strategies. And you can publish them so that other people can see them. You also get to earn interest on any uninvested cash in your account, and that'll be at roughly money market rates. Currently, the rate for sterling is 5.2%, although you can check on their website to find out the latest rates. If you've got cash in different currencies, you'll also earn daily interest on those too. So for euros, you'd currently earn 4.2%. For US dollars, you'd earn 5.1%. Plus, in March of 2024, Trading 212's launching a card. Now that's going to be linked to your Invest account, and of course it'll earn interest, as we've just discussed. You can also earn 0.5% cash back on your purchases, up to a maximum of £20 per month. And you can convert money to other currencies at a fee of just 0.15%. And the fee is exactly the same on weekends. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can get a free fractional share worth up to £100. To be eligible for that, you have to create a new account with Trading 212, fund it with at least £1, verify the account, and then use the promo code, which is my name, RAMIN, and there'll also be a link to that in the description below. So what would actually make money market fund yields fall? The primary driver is going to be falling inflation. As the central bank thinks it's got inflation licked, it's going to cut interest rates. Now that hasn't happened yet, and that's because central banks aren't convinced inflation is going to carry on falling. It's fallen a lot, the rate of inflation, since its peak last year, but that disinflation, a fall in the rate of inflation, still isn't enough to convince central banks that it's going to stay at a fairly subdued level. Plus, central banks look at something which is called core inflation, driven mostly by wages in developed markets, which has turned out to be very sticky indeed. So until core inflation falls as well, very convincingly, I don't think there are going to be any big rate cuts soon. Certainly not from the Bank of England, because as you can see, the UK has been a bit of a laggard when it comes to falling inflation. If we look at central bank policy rates as I make this video in March of 2024, you can see that all three major central banks, I haven't included the Bank of Japan here, but all three of them haven't yet started to cut interest rates. They're certainly thinking about it because of that disinflation, but they haven't actually started to do it yet. Now, when they actually do start cutting rates, I don't think they're going to do it very rapidly. We're not going to go to 3% or 2% tomorrow. The reason being, they don't want to let inflation flare up again. If that happened, they'd have to turn around their policy very quickly, and it would make them lack credibility. So they're probably going to be very cautious as they cut interest rates. What does that mean to you? Well, it means that the money market funds that you've invested in, assuming you have, will see their rate of interest fall very slowly as well. So that means you're going to have time probably to move your money out of money market funds into bond funds with greater duration and hopefully some term premium. So don't panic, you can do this in stages and it doesn't have to be in one go. But if we're thinking about the driver of falling rates of return on your money market funds, it's primarily what happens with inflation. So keep a very close eye on core inflation because that's what central banks look at. When you strip out energy and food prices, that tends to be less volatile and a better predictor of future inflation. That's why central banks like it. Now, once you do decide to move away from money market funds, what should you buy in their stead, in your safe bucket? Well, something with a bit more duration risk. And the reason for that is because of term premium. If we look back in the UK over a century, in fact 120 years, using data from the Credit Suisse Global Returns Yearbook, it's now the UBS Global Returns Yearbook, the nominal rate of return on UK bonds, total return, was 5.1% over that very long period. Whereas money market funds, which effectively are the same thing as bills, would have returned about 4.5%. So about a 0.6% difference. That's the term premium benefit. And term premium over recent years was probably even higher. It really depends on how steep the yield curve is to determine what that term premium is going to be. But the key point is that there was term premium, whereas at the moment there isn't any. So it's worth getting exposure to that increased duration risk. But what you should be aware of is that duration is a risk. You buy something which is much more volatile when you buy a longer duration bond. Here I've compared two funds, a money market fund, one of the 6 that we saw previously, and a fund which is fairly standard, which buys a variety of UK gilts. So the gilt fund is in blue and the money market fund is in red. Notice how volatile the bond fund is. It's all over the place. And when interest rates increase very sharply in 2020, 2021, 2022, notice how the price of that fund plummeted. Contrast that with a money market fund, which seems completely oblivious to the sharp increase in interest rates. So yes, duration risk is real, and if you go for very long duration gilt funds, then you're going to be seeing a lot of volatility. It's almost equity-like. But usually you're compensated for that risk because of term premium. Now personally, my preference is now to buy single government bonds, single gilts. The reason for that is that I've got the choice then when to sell the gilt or whether I sell it at all. Most of the time I'll hold the gilt to maturity. That means if yields rise or fall, I don't care. I've locked in a rate of return on the day I bought the bond. I know exactly what I'm going to get. I might have some FOMO if I see I could have bought the same bond for less money, but still, I've locked in my rate and I'm happy. So interest rate risk doesn't really affect you if you hold to maturity, and that's your choice when you own a single gilt. Contrast that with a fund. It's like a portfolio of bonds and you don't really know what's in it, and it never matures, so you can't hold it to maturity unless you buy one of these new fixed maturity ETFs like iBonds, but those are fairly restricted in choice in the UK still. So if I had to choose, what I'd do is I'd look at the yield curve, I'd look at where the yields were most attractive, and maybe consider taking some duration risk. There's also a consideration of how long you want to lock in your money and why you're buying the gilts in the first place. In my core portfolio, I have no bonds at all, for example. But if I was in retirement or just more cautious, I would consider holding a portfolio of gilts, single gilts, or at a push, a bond fund. If you don't like volatility, keep it to shorter term bond funds. You can find those on Just ETF. And if you're feeling particularly brave, maybe even long-term government bonds, gilts. But just be aware of the volatility that comes with that. If interest rates increase sharply, you could take a big paper loss on those funds. So would I be moving out of my money market funds right now? Probably not, simply because the rates just don't justify it. Also, I think once the Bank of England does start to cut interest rates, it'll do it very cautiously. And that's because it's scared of inflation flaring up again. So I think there'll be plenty of time to move out once I decide to move out of a money market fund. In my fund portfolio, I do have some money market funds. So when that starts to happen, I'll choose points on the yield curve which I think are attractive, and I'll move my money into single gilts. Government bond funds are just not for me anymore. Now don't forget our offer from Trading 212. If you decide to open a new account with them and you fund it and you verify it and you use our code, the promo code, which is my name, RAMIN, Romin, then you'll get a free fractional share worth up to £100. And as always, thank you for listening.